Hi, Chris Duff over at Serious Land Capital Vacant Land Funding Partner. So today wanted to go over how to actually calculate returns within your business. There's a million different accounting methods, so uh, you can definitely skin the cat different ways, so long as you're being consistent with it. But I think it's hard to escape what might be putting the investments that you are pursuing within your land business, in the black or the red when you actually break down true overhead expenses. So I was just commenting about this within Dave Deniston's Leadership in Land school community. It's free to join if you ever want to take a look at that. But they were just asking, key KPIs that you might track. And so one my partners and I have been utilizing since the start of us being in the land industry is allocated overhead or allocable overhead. But one or the other, they mean the same thing here. So basically that will break up every non-property specific expense associated with running your company from the history of starting your company. So, like the day you open up the LLC, the bank account, those expenses start being tracked and they are proportionally distributed or allocated across each asset that you bring into the actual business. Properties that were already sold or are currently in your portfolio would count in regard to distributing that allocated overhead. So what we often see here, and I get it like from a marketing perspective, you might hear, hey, I've never lost money on a land deal. I get why you'd want to say that and maybe actually believe that based on like the raw numbers that you're looking at. Any sophisticated or institutional investor, when they would try to break down a company's financial statements, like that wouldn't necessarily hold muster for more properties than you might think. The base way that you might start looking at profits into the business. Let's just say you sell off a particular property. We'll keep it simple here. We're not incorporating seller finance deals or kind of some more complex transactions that might get cash flow over time. Like this is simply a purchase and then a sale of a property with all the net income coming in at once. Most folks would consider the gross profit to be, net of any asset level commission, closing costs, whatever was spent directly on that property. So say you needed drone photography or needed a survey, septic, what have you, all of those would go into that gross profit calculation. So you're just subtracting all of those expenses associated with that specific asset, and you arrive at your profit number, assuming there was profit in the property. But in order to arrive at a true net profit, this is where it can get a little bit more complex in terms of how you allocate the overhead of running your business. So like I mentioned for us, and that there is a certain level of art involved here, but the way that we'll do it is, again, you're tracking every single expense not associated with the any asset level purchases. So, any of your software solutions, general acquisition marketing or disposition marketing expenses, personnel costs, salaries, contractor costs that are, not related to a specific asset, but, just for general business operations, gas for your car, whatever is being expensed within the company, that is all entering a pool that will, again, be distributed across all properties that you've ever purchased and are currently in your portfolio. So for example, the current allocable overhead or allocated overhead that we're running in our business is roughly $3,200. So what we need to do for every single property that we purchase, we take that gross profit margin, we subtract $3,200 and arrive at what the true net profit will be. Now you can see where the size of each deal can influence the margin more significantly or not. Let's say we bought a $100,000 property, sold for $200,000, gross profit was like $50,000, for instance. Again, we run a funding business, so we're going to be profit splitting and so forth. I'm just throwing out kind of round numbers here. But coming back to us, $50,000 from a gross side at the actual asset level, and then I'm subtracting another $3,200 to arrive at $6,800 in terms of my actual net profit allocated to that specific asset. Now, of course, that allocated overhead can be adjusting over time. If I buy a lot more properties or I subtract my general business expenses, my allocated overhead shrinks. Or if I'm not buying as many properties and my general business expenses increase, then my allocated overhead increases here. So it's a flexible number. It doesn't stay firm. Generally, you want to keep it as low as possible. If it's close to zero as possible, great. With the balance being, can you still grow your business with as lean of in overhead as possible? That's a whole nother discussion. But just to show you like that number doesn't always stay the same. We try to keep it, ours is roughly around 3,000 and it has been running around there for a while. So we have pretty, consistent monthly and annual expenses across the business, and we keep our rate of acquisitions pretty consistent as well. Roughly one every 50 deals being sent to us is being invested in. Yes, we're growing as well, so we may be doing even more. That should be decreasing overhead, but at the same time we're going after higher value deals too, so that might decrease the total volume of individual deals while still increasing the total principal needed for the company and possible revenue in. So that's kind of another factor to keep in mind in terms of how are you defining volume, just based on deals or actual capital being deployed there. So that gives you a little bit insight on how we are utilizing it. But on the flip side, let's say instead of a $100,000 deal, I was doing a $10,000 purchase, sell for 20, and I'm netting or I'm grossing $5,000. Same ratio as the $100,000, sell for 200, gross 50. And this time I'm still grossing 50% on the deal, but I have the same allocated overhead of $3,200, which, demolishes my absolute returns, and relative returns, for that particular property. Smaller properties are going to be hit harder from an allocated overhead perspective. Now, again, this is why I mentioned there's a bit of an art to it. Depends how you might internally run your finances, again, so long as you're consistent, where you can have certain thresholds of purchase prices or exits within your portfolio that receive a greater share of allocated overhead versus not. Let's say, and again, it can get complicated, right? The more nuance you throw into these calculations, you have to keep in mind the different proportions of size of deals that you have available. Where that's why it tends to be easiest just to have one allocated overhead associated with each purchase, because maybe I say, hey, I want to give double the allocated overhead for any deals above $100,000 that exited out. But if I'm not doing those in the kind of same volume as lower value deals, then my overhead my calculations might become inaccurate because I'm misweighting the overhead in relation to total volume of deals that I'm doing at each level. So that's just something to keep in mind. It is possible. We have done that in the past. We don't do that anymore. So I think, it was a bit too hard to track routinely. So That's why we prefer to just do it as one flat rate per deal, which again incentivizes going after larger deals because it's less impact on your total or your relative proportion of profits. But again, if you're doing huge volume of low value deals, you decrease your allocated overhead even more. So then you might be able to get it low enough where it's not proportionally disrupting your relative returns from that perspective. Different discussion, but it's the savvier investor would also include rate of inflation for total length of time that you've held an asset. True inflation, when you consider the debasement of currency plus just core inflation metrics, is actually close to 11% in the US. That's a whole nother discussion topic. But if you're just we're recording this in early 2025, it's probably only going to rise later on. But if you're considering you held a property for 12 months, that would be a super long sales timeline in this industry, then you would want to incorporate another 11% decrease in terms of net return based on the current rate of inflation for US dollars. And if you're using other people's capital too, especially if you're leveraging yourself, you'd want to include the cost of capital as well, which could be separate from the typical allocated overhead with just baseline expenses within your company. As I was talking through this, this would almost be helpful to like whiteboard this out. I totally understand maybe that this is kind of going over your head a little bit, just me speaking at you about this. But hopefully the base idea of just making sure you're tracking your business operation expenses and incorporating that into the cost of each deal for true net numbers is critical to actually understand how profitable your business is being on an asset level basis. Because if you just, kind of go by that, statement, hey, I even though I only made, $100 profit on this particular deal, like that just falls apart because your true net incorporating overhead is just presumably inflation just, makes that property a loss. So, we just try to be as honest and realistic as possible when it comes to calculating our true returns. And this is all built within kind of a custom-made accounting spreadsheet that we've put together over the years here. I've shared it with some folks. Love going over this. So if you ever have any questions, feel free to reach out, subscribe, and share. Hopefully this was helpful. SeriousLand.capital for any of your funding needs. Landpricer.ai was just chatting with my engineering team, got a lot more done and tickets addressed earlier today. And Land Daily Diligence, we're going live tomorrow for zero cost review of your land deals. With that, take care. Bye.